stock market crash coming again? Is this another stock market crash? In this video, I'll be sharing with you my analysis and whether I believe this stock market decline is the start of a new stock market crash. And at the end of the video, I'll be sharing with you my strategy on how I plan to protect my profits during this period. So stick till the end of the video if you want to find out all of that. Okay, let's begin. This is the price chart for the S&P 500 or the SPY. Prices declined significantly in the past week, specifically on Thursday, right? So this was Wednesday and this was Thursday. So you can see that prices gapped down or significantly declined on Thursday. In fact, stocks suffered their biggest one-day pullback in 3 months on Thursday. What were the reasons behind the significant decline of stock prices on Thursday? There are two main reasons why stock prices declined significantly. Let's take a look. The first reason was because of the bleak outlook by the Fed. If we take a look at this article here, the Fed warns of extraordinarily uncertain path to recovery, right? And the Fed report sees a fragile road back to steady growth and employment. So this is the full article. So let's take a look at the article. The article mentions that the Fed painted a sober picture of the economy on Friday, declaring that the financial system remains under stress because of the pandemic and that the path back to steady growth and a strong labor market is unsure. So that is not a very optimistic outlook by the Fed. The Fed also released their projections last week. These are some of the numbers that they released last week. So they mentioned that these are the key numbers for 2020, followed by the next 2 years and the long run projection. So they projected that the US GDP is likely to decline 6.5% in 2020, but increase 5% in 2021 and increase 3.5% in 2022. And for unemployment, the Fed projected unemployment rate to be at 9.3% in 2020, 6.5% in 2021 and 5.5% in 2022. As for inflation, it will be 0.8% this year, 1.6% next year, and 1.7% in 2022. So if we take a look at these projections provided by the Fed, while the numbers are not great, it however shows an improvement in the coming years. If we take a look at GDP, this year will be bad, right? So GDP is expected to decline by 6.5%. However, if we take a look at 2021 and 2022, we see a positive growth in GDP, right? So 5% in 2021 and 3.5% in 2022. As for unemployment, this year will be very high at 9.3%. But if we take a look at the subsequent years, unemployment rate is expected to decline. So there's an improvement in unemployment rate. So while the Fed has a bleak outlook of the economy right now, they project an improvement in the coming months and years. However, these projected numbers and figures are really dependent on the pandemic situation. And that is why the Fed is uncertain about the recovery, because the recovery depends heavily on the pandemic situation. And the pandemic situation by its very nature is uncertain. So the uncertainty in the recovery of the economy is the first main reason why prices declined significantly in the past week. The second main reason why prices declined significantly in the past week is because of the threat of a potential second wave of infection. As more and more countries ease their lockdown measures and people resuming their activities, this increases the threat of a potential second wave of infection. So if we take a look at this article here, they mention that as of Saturday, the pandemic cases were climbing in 22 states amid reopenings in the US. If the second wave of infection comes, hopefully it doesn't, fingers crossed, then this will devastate the economy. And the potential devastation of the economy due to a second wave of infection is the reason why prices declined significantly in the past week. The Washington Post also mentions that the potential for a second virus wave and another lockdown is a worry, and there is concern over possible slower pace of recovery. And the fact that the market had become more optimistic and more enamored over a V-shaped recovery in recent weeks, and anything that would disrupt that view was a vulnerability. So those are the two main reasons why the stock market declined significantly in the past week. The first was because of the uncertain recovery of the economy projected by the Fed. And the second is because of the potential threat of a second wave of infection that could potentially devastate the economy. An unrelated but good point to take note is that many Americans use part of their stimulus check to trade stocks. Most major online brokers such as Charles Schwab, TD Ameritrade, E-Trade, Interactive Brokers, and Robinhood all saw increase in activity and sign-ups on their platform. In fact, Charles Schwab saw a record 609,000 new accounts in Q1, and millennial-favored stock trading app Robinhood saw daily trades up 300% in March year-on-year. By now, you have probably realized that what the Fed says and what the Fed does has a huge impact on the stock market. And if we are doing comparisons here, the Fed is like Thanos in the Avengers movie. A nickname that I give Jerome Powell, the chairman of the Fed, is Panos, right? So Powell and Thanos, and you get Thanos. So that's a nickname that I give to Jerome Powell. In the Avengers movie, after Thanos collected all of the Infinity Stones and did his snap, half of the population were wiped out. Which were the group of Avengers that vanished and disappeared, and which were the group of Avengers that remained? The group of Avengers that remained were the original Avengers, right? So it was Iron Man, Thor, Captain America, Black Widow, and a couple of others. And which were the group of Avengers that disappeared? The group of Avengers that disappeared were the newer Avengers. So Avengers like Doctor Strange, Spider-Man, and Black Panther, and a couple of others disappeared. So they were the newer group of Avengers. And when Thanos did his snap last week, which group of investors and traders do you think are most likely to disappear and vanish? And which group of investors and traders do you think are most likely to remain? If we take a look at the price chart when Thanos snapped his finger last week and prices declined significantly, the group of investors and traders who are likely to vanish and disappear are the new investors and traders. The newer group of investors and traders who only started investing and trading in the stock market in the past couple of weeks and past couple of months are most likely to only experience rises in their stock price. So when stock price declines significantly, what happened to this newer group of investors and traders in the stock market? This group of newer investors and traders in the stock market who up till last week never experienced a steep decline in prices are most likely to vanish and disappear during this steep decline in stock prices. Coincidentally, if you take a look at this article, Robinhood told CNBC that over half of its customers are first-time investors. So these first-time investors and traders in the stock market are likely to be the half that disappeared when the snap came along. So is this another stock market crash? I personally do not believe that this is a start of another stock market crash. But if you're watching and you are investing and trading the stock market, do not base your decision in the stock market based on my opinion. Instead, base your investing and trading decision on your own research and analysis. In one of my previous videos that I did about a month ago, I shared the reasons why I am bullish and optimistic about the stock market. And you can check out the video over here. And in the video, I mentioned that I made my analysis based on two important assumptions. One, that there will be no second wave in the pandemic situation, and two, the Fed continues its quantitative easing program for the foreseeable future. So while the Fed is uncertain about the recovery in the economy, the Fed is still continuing its quantitative easing program. They might be scaling back on some of its programs, but at the same time, they are scaling up on some of their other programs. Overall, they are still continuing their quantitative easing program in the foreseeable future. So the second part still holds true. And the first assumption that I made was that there will be no second wave in the pandemic situation. For this case, the pandemic situation is a bit more uncertain. So while I'm still bullish and optimistic about the stock market, I'm not discounting the fact that there might be a potential second wave of infection. That is why, as investors and traders in the stock market, we must take into account all possible outcomes. With that said, let me show you what I'm watching out for on the price charts for potential signs of trouble. Okay, so this is the price chart for the S&P 500 or the SPY. We can see that prices declined significantly in the past week. So this was last week from Wednesday to Thursday. So prices declined significantly. So what are the things that I'm looking out for that might indicate to me that this decline is not just temporary and this decline is likely to continue in the future and might even be potentially a start of a stock market crash? The first thing that I'm taking a look at is the 200-day moving average. Right now, prices are hovering about the 200-day moving average. So prices close at the 200-day moving average. This one, prices close above the 200-day moving average. And on Monday, prices also close above the 200-day moving average. How prices react to this 200-day moving average is the first indicator that I'm looking out for. If prices continue to close above the 200-day moving average, this indicates to me that prices are still bullish. However, if prices close below the 200-day moving average and continues to close below the 200-day moving average, this indicates to me that prices are bearish. So the first thing that I'm looking out for is how prices react to the 200-day moving average. The second thing that I'm looking out for is the 61.8% Fibonacci level. At this 61.8% level, it used to be a old resistance level. So right now, it is a new support level. So that is another support level that I'm taking a look at. So if prices break below this important support level, in this case, the 61.8 Fibonacci level, then this indicates to me that prices are also bearish. The third thing that I'm looking out for is this lower trend line over here. So this trend line has been in place for a couple of years. So if we zoom out and we take a look at the price chart, you can see that this trend line has been in place for a couple of years. So it has gone back all the way to a couple of years, right? So it has been there for quite a while. So this trend line is a very strong support level. If we go back to where we are currently at right now in 2020, this is the current trend line. So if prices break below this important trend line, this indicates to me that prices are very bearish and this might be a start of a second stock market crash. So those are the three things that I'm looking out for that will indicate to me whether this might be a start of a potential stock market crash. But right now, I'm bullish and optimistic about the stock market because prices are still holding up against these levels. If you have liked this video, smash that like button because it will help the channel grow. And if you want to watch more videos such as this, make sure you subscribe to my channel because each week I release one new video about investing, trading, and the stock market. And you don't want to miss any of these videos. I'll see you in those videos to your financial success.